Welcome to the Wealth Renegade podcast. I'm your host, Robby Butler. Have you celebrated your financial independence today? I'm here with my new friend and fellow Arizona resident, or I guess I'm no longer the Arizona resident, but an Arizona resident, Weston Walker of West Rock Equity. Weston, thank you for joining me.
Yeah, thank you, Robby. Glad to be here.
You have a most unique perspective. Most people come into real estate at some point along their professional journey and they perhaps follow the typical model of single family and they move into multifamily. And then perhaps at some point they realize syndicated real estate is a benefit, or perhaps they skip a couple degrees of growth and they go into the real estate investment trust space or the REIT space and they lob themselves into being a part of enormous opportunities. But you picked something that is very scalable, very early on in your experience. How did that come to be? Tell us a little of the background.
Yeah, so I'm 20 years old. As a background, I grew up in Illinois. I'm in Arizona now, college student, and got into real estate a couple years ago when I was 18 years old. Got a fourplex after I started some businesses in high school. I'm like, I wanted something more scalable, something more long term, rather than transactional side hustles that were really short term in high school. But I did make some money doing that. I had a subscription group, people paying me $60 a month. I think I had 40 members at the time. But I scaled that. I sold that business, got a fourplex, did some renovations, helped my dad out with it as well. We did it as a side project. So started with the fourplex and started reading books about syndications, about what the wealthier people did in the space. And I found out that they used other people's money to buy deals. And I tried buying entire asset like multifamily, 20, 40 unit property when I was 18 years old trying to raise money for it. Obviously, that didn't work. So I had to find a partner who actually had these deals and I could be a small partner on the deal. And they had the expertise in managing the property. So I could leverage their expertise to go pitch investors. And so what I do now is I raise money for these multifamily properties from LP investors, the limited partners. They get their share of the returns from the property. And then I get involvement as well from learning from the sponsor, learning from the investors what objections they have, and seeing how both sides, the investors and the sponsor, how they view the investment opportunity. What are the benefits? What are the risks? And so that's my main thing right now is learning as much as possible.
It gives a fantastic flavor to the investor who understands some of the deal structures we're describing, because for you, you had an early business experience that allowed you to level up and realize I should pursue scalable models, which again is typically the space that people hit a ceiling of complexity and they can't solve their way out of it. They can't suddenly, increase their income by 10 times to go buy little assets by themselves. And the way they choose to solve that problem is by having other investors passively invest with them. So you figured all of that out at such an early trajectory. I'd love to begin our conversation by stretching out the vision. How long do you anticipate being involved in real estate for as you look way out into the future? Talk to me in terms of decades. What's the vision for you?
Yeah, so I saw you actually did an interview with Richard Wilson in the past, and he interviews or he actually works with and interviews wealthy families. He throws on conference events around the country with billionaires and how they manage their money. And each one of them usually has a bucket of real estate in their portfolio. They have their main investments, which are usually liquid, stocks, bonds, the traditional financial advice. They also have real estate, which is another bucket. Then they have different asset classes, usually 80% cash flowing, 20% development, which is a little bit riskier. I'm personally in the cash flowing assets, cash flowing multifamily, considering development in the future. And then the wealthy families also have their specific niche that they built their wealth in. For example, an extreme example, Elon Musk building Tesla, and he has expertise in cars. Some people have expertise in technology, and they make investments into technology because they have the connections there and they know how to build wealth in that industry. And so I think to answer your question, I think real estate will definitely be a piece of my entrepreneurship and investment journey for the long haul.
And do you see it being only a piece? Do you see it being the major piece? Do you see building up multiple businesses in multiple sectors? Tell me a little more of the vision.
Yeah, I don't want to get too distracted here. So I think real estate I want to build an alternative asset management platform, kind of like Blackstone, but that's huge. I mean, that's way down the road. It's going to take a lot of work. But I do really like the private equity side if I can find a specific niche. What I'm working on right now is I'm not too experienced in private equity. I know the real estate market a lot better, is reaching out to managing partners, general partners of these private equity firms and interviewing them on my podcast, asking them questions that I'm curious about and other people would be curious about as well. So that's how I'm going to learn about private equity is interviewing those people before I actually jump in that space. But for the near future, I think private equity, the next 10 years, or sorry, real estate private equity, just raising money from investors for properties, will be the major focus for the next 10 years. But private equity takes a lot more skill because you have to know the people and you have to know the niche of the businesses that you're getting into.
You mentioned Blackstone. Steven Schwarzman got his early business experience working with his dad, and his dad had a very successful, very profitable small business. I think it was somewhere on the East Coast. And Steven Schwarzman is known for asking his dad, we could buy a whole bunch more stores. We could expand this. We could push this to massive scale. And his dad said, why? It's plenty profitable. I'm doing just fine. I'm extremely happy. And yet, Stephen had that motor turning in his mind, even at a very young age, that this could go big. And of course, he's had his bumps in the road. And at the end of that, he got Blackstone. You have the similar advantage of having an extremely long time horizon you can work on. Do you have any comments on that? Because you've got
Yeah.
such an early grasp, tell us about kind of what that feels like to have the long runway to be able to work with.
Yeah, I'm very fortunate that I'm learning from some of the best people at a young age. It didn't come from family for the most part. I mean, my grandpa had one connection in the real estate space, but that's it. And that's not how I got into the real estate space. My dad's a fireman. We're from like a medium-sized town in Illinois where the average home price is like 90 grand. And compare that to Arizona, it's insane. So I had to hop on LinkedIn. I've scaled my LinkedIn to about 8,500 followers now. In the last 2 years, I've started posting a lot, reaching out to a lot of people, and the podcast as well has helped a lot with me gaining connections. But yeah, learning from the best people is definitely a priority. I'd say getting in at a young age. I mean, Warren Buffett started when he was, I think, 12 or 11 or 12, just getting into things, and he averaged like a 20% return, which doesn't seem like a ton, but it really is once you compound that for the years to come.
I think it's Charlie Munger who says, money is like soap. The more you play with it, the less you have. I think it's a Charlie Munger quote. And he says that because so many people's financial experience is them taking 5-year chunks of their time and their focus, playing with it a whole bunch, and then moving on to the next thing where they end up decreasing the amount of working capital because they're constantly on a learning curve. And for you could play for the next 30 years and you'd still have an ultra long runway to stabilize, to grow at that compounding rate that we're describing. And you can play with it, but you also have the ability to be able to say, what happens if I stick with real estate for an ultra long time horizon, which is
Totally. Yeah, quick
me.
comment on that. If your listeners know Alex Hermosi, he built $100 million net worth by 30 or something like that. And he was talking with a trash business owner, and he made tens of millions of dollars in the trash business. And Alex Hermosi asked his friend in the trash business, "Hey, what are you gonna do next?" Because he sold his business. And he's like, "Oh, I'll just build another trash business." And Alex is like, "Why would you do that? You just built a trash business." And he's like, "Well, I've had 20, 30 years experience doing the trash business. Why don't I just do it again and remove most of the risk because he has all the expertise in that." So I definitely think there's benefits with sticking with something for a long period of time.
Another short story. A gentleman that I know of in Arizona commanded a masterful portfolio that he built for, I would guess, 40 years. And there was one singular asset, which basically was the cash cow for the family. It was a creme de la creme type of asset, multiple asset classes within a large portfolio on one acreage. And eventually, I think in 2006, he sold the asset. And everyone was like, why would you do this? You've owned it for 40 years. It was printing you money for decades. Why would you sell it? And he said, the cap rate changed. I can always go find another asset, but the cap rate changed for him for the better. Cap rate lowered, so he was selling it at an optimum price. And then, of course, 2007 happened, 2008 happened, wiped out the valuations of the majority of what he had already sold. He was a
Totally.
winner in that because he had such a perspective. Let's talk about multifamily a little bit. What is it you find so appealing about that asset for your investors and for yourself?
Yeah, we're in a stage right now in the economy where AI and tech is really prevalent. I mean, multifamily is going to be here for the long haul unless they build some magic tent that pops up. But I mean, real estate, everyone's going to need a place to live. It's just how you buy it and the sponsor that you're investing with, making sure they have number one, a track record. Everyone says that. But the main thing that investors should look for, limited partners, is the platform of the sponsor that they're investing with. Do they have the asset management team? Do they have the construction if they're doing development or value add? Is it in-house? Is it outsourced? How do they structure their deals with the waterfall? What is their motivation behind the deal? And you have to talk with many of the team members to figure that out and how they do their reporting, make sure that's really transparent. That shows, you know, honesty and integrity from the sponsor. So there's a lot of different things that investors should look for that combine into a good investment and a strong return.
Is there something specific about the multifamily asset class that you like more than perhaps industrial or commercial retail or strip centers or marinas or anything else you can pursue?
Yeah, to be completely honest, it's the most simple for me as I'm just getting into the space. And there's definitely opportunities in other asset classes and great sponsors that I know in those different asset classes. And I think for me, I know the most about multifamily and can bring the most value there. But in the future, I could definitely learn or bring on partners that know the different asset classes better than I do.
A last question here, and we'll see how long we delve into this. But for you, one advantage of you and I not having perhaps the gray hair that some of the sponsors have who are renowned in the space and who have been doing deals for 3 and 4 decades is that we see trends differently. A great book just came out by the founder of 538 and Real Clear Politics, who writes about the perception that huge entrepreneurs have where they are able to see trends and wrap their minds around the trends with the data to go to support it. And young people have a different view of trends than people with more experience do. Are there trends that you're specifically excited about that either support real estate or multifamily or anything like that that you see on the ultra long term horizon will be exciting for you to take advantage of?
Yeah. I mean, right now we're getting about 20 to 30% discounts on multifamily from now. And that was in 2022 when the asset prices dropped about 20%. Another big trend that we're seeing is people are scared to invest right now. I talk to a lot of individuals where they're like, oh, the economy might crash because so and so is going to get elected. There's an election coming up and we can't ignore that. So we have to be able to be flexible and to pivot. And that's where we come in. I mean, you guys are a flexible firm and you can invest in different asset classes, which you mainly focus on multifamily and development. But we definitely have to be flexible in the upcoming future because we don't know exactly what's going to happen.
It's part of the art of investing is knowing when to touch, when to push, when to pull back. And as you get to experience cycle after cycle, you start to realize, like the story of the investor I mentioned, they knew, oh, they'd held that asset for 40 years, but the cap rate changed and it changed in a way they'd never seen before, which meant time to let go, time to play a different game while everyone else bumbles along. And the other thing to reinforce your great point, there's always an election coming up. Unless the world really goes bad, there's always an election coming up. You can pick every 2 years, every
Yeah.
4 years. You can find a sheriff's election every couple or not a sheriff, but, different political parties are nominating at different elements of the political cycle at all times. And so you have to find things that are even longer term to stick your hat on.
Yeah, and what to look for as well is the activity from institutional investors. Are they willing to put money to work or are they holding back and sitting on a pile of cash waiting for something to happen? And if they're sitting on cash, there might be deals in the market. I mean, the group I'm working with, they bought deals from Blackstone because all their investors wanted, or not all of them, but some of them wanted to pull money out of their fund and their REIT. So they hit their max redemptions in their REIT, so they were forced to sell their assets, and that's where some of the deals came in.
It's an excellent point. If someone is constrained by investor requests, they might have to sell even if there's no other distress. Internal distress is distress, even if it's not visible on the property or in the legal arrangement or in the lending arrangement. Distress is distress, and if you can capitalize on it, you can find opportunities in any marketplace. Weston, any final comments before we sign off and find out how folks can follow you?
Yeah. So, any final comments? I mean, the main thing to look for in a sponsor is their platform that they're investing with. A lot of people say track record, but what is their platform? What is it comprised of? And is that able to handle, all the investments that they're doing? And so, yeah, where people can reach me is LinkedIn, Weston Walker. Weston is spelled with an O. My email is weston at westrockequity.com.
Very cool. Weston, it's been great to have this conversation with you. I look forward to remaining friends over the long haul because it really is in the long haul that you make a dent in the universe. So it's been great to meet you.
Absolutely. Thanks for having me on, Robbie.